How investing really works for beginners. Most people think investing is about money. It's not. It's about understanding how money behaves when you stop touching it. Welcome to Money Depth Insights. I'm your finance guide, John Array. Today, we're going to break down how investing really works in a clear and practical way, especially if you're a beginner. To make sure nothing feels confusing or rushed, I've divided today's topic into 4 deep parts. So let's start from the foundation. Part 1. The truth about what investing actually is. Before we talk about stocks, markets, profits, or returns, we need to clear one very common misunderstanding. Most people believe investing is something you do. In reality, investing is something you allow. You allow time to work. You allow systems to operate. You allow growth to happen without interference. This is why so many beginners struggle. They try to control what cannot be controlled. Real investing begins when you stop trying to force outcomes and start understanding processes. Why investing is not gambling. Let's address this directly. Gambling depends on luck. Investing depends on probability and patience. In gambling, outcomes are short-term. Odds are fixed against you. Repetition increases loss. In investing, outcomes are long-term probabilities. Improve over time, discipline increases success. When people lose money investing, it's usually because they treated it like gambling. They chased quick wins. They followed tips. They reacted emotionally. That behavior has nothing to do with investing. What you are actually doing. When you invest. When you invest, you are doing one simple thing. You are exchanging short-term certainty for long-term potential. Instead of keeping money still, you place it into businesses, productive assets, economic activity. You are saying, I don't need this money right now. I want it to grow over time. That single decision changes everything. Why beginners feel confused at the start. Confusion doesn't come from lack of intelligence. It comes from too much information at once. Beginners are shown charts, indicators, predictions, opinions, but they are rarely taught how the system actually works. Imagine trying to drive a car by staring at the speedometer without knowing where the engine is. That's how most people approach investing. Money has only 3 jobs. Every unit of money can do only one of 3 things. Be spent, be saved, be invested. Spending gives comfort now. Saving gives security now. Investing gives growth later. Problems begin when people expect saving to create growth. Saving protects money. It does not multiply it. Why? Keeping money idle is risky. Many beginners think not investing is the safest option. In reality, doing nothing is a silent risk. Why? Because money loses value over time. Inflation quietly reduces purchasing power. It doesn't announce itself. It doesn't feel dramatic. But over years, it changes lifestyles. Investing exists to fight this invisible enemy. The difference between price and value. This is one of the most important ideas you'll ever learn. Price is what you pay. Value is what you receive over time. Markets move prices every day. Value changes slowly. Beginners watch prices. Investors focus on value. When you understand this difference, investing becomes calmer. Why short-term thinking creates long-term loss. Most mistakes in investing come from short-term thinking. People want quick results, fast proof, immediate rewards. But investing rewards delayed gratification. The market transfers money from the impatient to the patient. This is not a slogan. It's a pattern repeated for decades. Why time is more important than timing. Beginners ask, when is the best time to invest? Experienced investors ask, how long will I stay invested? Time multiplies small decisions. Timing only tries to impress. Starting early with small amounts often beats starting late with large amounts. The role of compounding. Without math, compounding simply means growth building on growth. Returns earn returns. Progress accelerates quietly. At first, growth feels slow. Then it becomes noticeable. Then it becomes powerful. This is why consistency matters more than brilliance. Why doing less often produces more beginners feel they must constantly act. In reality, most successful investors buy thoughtfully, wait patiently, adjust rarely. Action feels productive. Patience produces results. Doing less is harder than doing more. That's why few people master investing. A simple mental model for beginners. Think of investing like planting a tree. You don't dig it up daily, check roots every week, move it constantly. You plant it correctly. You water it. You protect it. Then you let nature work. Markets work the same way. Why education comes before action. The biggest mistake beginners make is starting before understanding. Learning first reduces fear, builds confidence, prevents emotional decisions. Investing without understanding is not brave. It's expensive. What you should take from this part. Before you invest a single dollar, understand this. Investing is not about excitement. It is about structure, time, and behavior. If you get the behavior right, the numbers follow. Part 2. Why saving alone will never build wealth. Let's start this part with a truth that many people find uncomfortable. Saving money feels responsible, but saving money alone does not create wealth. This does not mean saving is bad. Saving is necessary. But saving has a very specific role, and that role is often misunderstood. Saving protects money. Investing grows money. Confusing these two roles is one of the most common financial mistakes people make. Why saving feels safer than investing. Saving feels safe because it gives certainty. When your money is in a savings account, you know exactly how much is there, where it is, that it won't disappear overnight. The number does not fluctuate. There are no headlines. There is no drama. This psychological comfort is powerful. But comfort and progress are not the same thing. The silent problem with saving. Here is the part most people never think about. Even when your money is completely safe, it can still be losing power. Not losing numbers, losing purchasing power. This happens because of inflation. Inflation does not feel aggressive. It feels slow, almost invisible. But over time, it changes everything. What inflation really does. Inflation simply means that the same amount of money buys less over time. Things gradually become more expensive. Food, housing, transportation, education. Your money stays the same. Prices move up. So even if your savings balance looks healthy, what that money can do becomes weaker. This is why doing nothing is not neutral. Doing nothing slowly moves you backward. Why interest on savings is not enough. Many people say, but my savings earn interest. Yes, they do. But here is the key question. Does that interest beat inflation? Most of the time, the answer is no. When interest grows slower than inflation, your money still loses real value. It feels safe, but it quietly falls behind. Investing exists to solve this exact problem. Why investing was created in the first place. Investing was not invented to make people rich quickly. It was created to allow people to participate in economic growth, protect purchasing power, build long-term stability. When businesses grow, economies grow. Investing allows individuals to benefit from that growth. Instead of fighting inflation, you move with growth. The difference between activity and productivity. Saving is passive protection. Investing is productive participation. When money is saved, it waits. When money is invested, it works. It may feel uncomfortable at first, but productive money is more resilient over time. This is why every developed economy encourages investing. Why fear keeps people stuck in saving mode. Fear is the biggest reason people avoid investing. Fear of losing money, making mistakes, not understanding enough. These fears are natural. But fear often causes a bigger loss than action. Avoiding investing does not avoid risk. It simply replaces visible risk with invisible risk. Why beginners delay investing too long? Many beginners say, "I'll start investing when I earn more. I'll start when I know everything. I'll start when the market is perfect." But the perfect moment never arrives. Knowledge grows through experience. Confidence grows through exposure. Waiting delays learning. Delaying learning delays growth. Why small investments matter more than you think. Beginners often underestimate small amounts. They think, this is too little to matter. But investing is not about the size of the first step. It is about starting the process. Small, consistent investments combined with time outperform large, delayed ones. This is how compounding begins. How investing changes your relationship with money. Once you start investing, something important changes. You stop seeing money as something to spend or store. You start seeing money as a tool. You begin asking better questions. Where should this money work best? How long can I leave it untouched? What role does this money play in my future? This shift in thinking is more valuable than any single return. Why long-term thinking is rare but powerful. Human brains are wired for short-term rewards. We like quick results, immediate feedback, instant gratification. Investing requires the opposite. It rewards patience, restraint, consistency. This is why few people succeed long-term. Not because it's complex, but because it's psychologically demanding. Why market ups and downs scare savers. When savers look at markets, they see danger. They see headlines, volatility, uncertainty. But volatility is not a flaw of investing. It is the price of growth. Without movement, there is no opportunity. Investors learn to accept movement. Savers try to avoid it. Understanding the trade-off clearly. Here is the simple trade-off. Saving gives certainty but limited growth. Investing gives uncertainty but long-term potential. The mistake is choosing one forever. Smart financial behavior uses both, but for different purposes. When saving is the right choice, saving is important for emergency funds, short-term needs, stability. Investing is important for long-term goals, retirement, wealth building. Problems happen when people expect saving to do the job of investing. Why education reduces fear. Fear thrives in confusion. The more you understand how investing works, the less scary it feels, the more rational decisions become. Education does not eliminate risk. It helps you manage it. This is why learning before acting is powerful. But learning forever without acting is not. A realistic mindset for beginners. You do not need to be fearless to invest. You need to be informed, patient, realistic. Investing is not about being brave. It is about being prepared. Part 3. How the stock market actually works. Let's clear something very important right away. The stock market is not a casino. It is not a guessing game. And it is definitely not a place where prices magically go up and down without reason. The stock market is simply a system. A system that allows businesses to raise money, investors to participate in growth economies to expand over time. Once you understand this system, fear starts to disappear. What you really buy when you buy a stock. This is where many beginners get confused. When you buy a stock, you are not buying a symbol on a screen. You are buying ownership. Even if it is a very small percentage, you now own a part of a real business. That business sells products or services, earns revenue, pays expenses, aims to grow profits over time. Your investment grows when the business grows. The stock market is just the marketplace where ownership is exchanged. Why stock prices move every day? Prices move because people buy and sell. They buy and sell because of expectations, emotions, news, fear, and optimism. But here is the key point beginners miss. Short-term price movement does not equal business value. Markets are emotional in the short term. Businesses are logical in the long term. This gap between emotion and logic is where long-term investors benefit. Price is noise, business is signal. Think of price as noise. Think of business performance as signal. Noise changes daily. Signal changes slowly. Beginners focus on noise. Investors focus on signal. When you understand this difference, you stop reacting and start observing. Why volatility is normal. Volatility scares beginners because it feels unpredictable. But volatility is simply movement. No movement means no opportunity. Markets move because economies change, industries evolve, companies adapt. Volatility is not a flaw. It is the cost of growth. Trying to avoid volatility completely means avoiding investing altogether. How long-term growth actually happens. Over long periods, markets tend to grow because productivity increases, innovation continues, population grows, businesses adapt. This growth is not smooth. It comes with ups and downs. But over decades, growth reflects progress. This is why time matters more than perfect timing. Why watching the market every day is harmful. Beginners often check markets daily. This creates stress, not insight. Daily movements rarely matter for long-term investors. They only trigger emotional reactions. Successful investors zoom out. They focus on years, decades, business fundamentals. Less watching often leads to better decisions. The difference between investing and speculation. This distinction is critical. Investing is based on business strength, long-term value, patience. Speculation is based on price movement, short-term trends, prediction. Speculation can be exciting. Investing is usually boring, but boring builds wealth. Excitement builds stories. Why most people lose money in the market. People don't lose money because markets fail. They lose money because they chase hype, they panic sell, they follow tips, they act emotionally. The market rewards discipline. It punishes impatience. This pattern repeats again and again. Why diversification matters. Diversification simply means not relying on one thing. No single company, industry, or idea should decide your future. Diversification reduces risk, smooths outcomes, protects against mistakes. It does not eliminate losses. It makes them manageable. Why simpler portfolios often perform better. Beginners think complexity equals intelligence. In reality, complexity increases mistakes. Simple portfolios are easier to understand, easier to manage, easier to stick with. The best strategy is the one you can follow consistently. The role of index funds, conceptually. Without naming products, understand this idea. Index-style investing allows you to invest in many companies at once, reduce individual company risk, benefit from overall market growth. This approach removes the need to pick winners. It focuses on participation, not prediction. Why trying to beat the market is difficult. Professionals with advanced tools, deep data full-time teams often struggle to beat the market consistently. Expecting beginners to do it easily is unrealistic. This is why long-term participation often wins. How market crashes should be viewed. Market crashes feel scary, but they are part of the system. Crashes reset expectations, remove excess speculation, create long-term opportunities. Investors prepare mentally for downturns before they happen. Panic is a reaction. Preparation is a strategy. Why behavior matters more than knowledge. You can know everything and still fail. Because behavior determines outcomes. Successful investing behavior looks like staying calm, sticking to a plan, avoiding emotional decisions. Knowledge helps. Discipline decides. How beginners should think about returns. Returns are not linear. Some years are great. Some years are disappointing. Judging investing by short periods leads to wrong conclusions. Consistency over time matters more than any single year. A healthy expectation for beginners. You will not get rich overnight. Avoid all losses, always feel confident. You will learn continuously, make mistakes, improve over time. That is normal. Part 4. How beginners should actually start, without stress. By now you understand something most people never do. Investing is not about speed. It is not about excitement. And it is definitely not about being clever. Investing is about behavior, structure, and time. So let's talk about how beginners should actually begin, in a way that is realistic, calm, and sustainable. Why most beginner advice fails. Most advice fails because it skips the foundation. People are told what to buy, when to buy, what returns to expect, but they are rarely taught how to think, how to behave, how to stay consistent. Without the right mindset, even good advice becomes harmful. The first rule. Beginners must accept. Here is the first rule that removes pressure. You do not need to be perfect to start. You need to be consistent. Waiting for perfect knowledge delays progress. Learning happens through participation, not observation alone. Start small. Start simple. But start. Why starting small is a strength. Many beginners feel embarrassed starting with small amounts. This is a mistake. Small investments reduce emotional pressure, allow learning without fear, build habits. Your first investments are not about returns. They are about experience. Experience builds confidence. Confidence builds discipline. How to think about risk as a beginner. Risk is not something to eliminate. It is something to understand. The biggest risks for beginners are acting emotionally, following trends, investing without understanding. Risk decreases when you diversify, you think long-term, you avoid unnecessary complexity. Understanding reduces fear. Fear causes mistakes. Why long-term thinking feels unnatural. Long-term thinking goes against human instinct. We are wired to react, respond quickly, seek immediate feedback. Markets reward the opposite behavior. They reward patience, calmness, delayed gratification. This is why investing feels uncomfortable at first. Growth often feels boring before it feels rewarding. The role of discipline in wealth building. Discipline is not about willpower. It is about systems. A simple system removes emotion, reduces decision fatigue, creates consistency. The less you rely on motivation, the better your results. Motivation fades. Systems endure. Why comparing yourself to others is dangerous. Beginners often compare returns, portfolios, timelines. This comparison destroys clarity. Everyone starts at a different time. Everyone has different goals. Everyone has different risk tolerance. The only comparison that matters is, are you improving your understanding and behavior over time? What real progress looks like. Progress in investing looks like fewer emotional decisions, more patience, better understanding, calmer reactions. It does not always look like fast growth. Calm progress often beats dramatic moves. Why market noise should be ignored. News is designed to attract attention, not build wealth. Headlines exaggerate. Predictions conflict. Opinions change daily. Long-term investors filter noise. They focus on fundamentals, consistency, time. Ignoring noise is not ignorance. It is discipline. The power of staying invested. One of the biggest advantages investors have is simply staying invested. Trying to jump in and out of markets often leads to missed opportunities, emotional stress, lower returns. Time in the market beats timing the market. This principle alone explains why patient investors often outperform active ones. Why mistakes are part of the process. You will make mistakes. Everyone does. Mistakes become expensive only when they are repeated, lessons are ignored. Ego blocks learning. Mistakes become valuable when they are understood. Behavior improves discipline, strengthens. Learning is not optional in investing. It is built into the process. How to build confidence the right way. Confidence does not come from predictions. It comes from preparation. You gain confidence by understanding what you own, knowing why you invested, accepting short-term uncertainty. Confidence based on knowledge lasts. Confidence based on luck disappears. Why investing is a personal journey. There is no universal perfect strategy. Your strategy should match your goals, your timeline, your temperament. The best strategy is one you can follow during both good times and bad. Consistency matters more than complexity. What investing is really teaching you. Beyond money, investing teaches patience, self-control, long-term thinking, emotional discipline. These skills transfer into every area of life. This is why investing is more than finance. It is a mindset. Putting everything together, let's summarize what you now understand. Investing is about participation, not prediction. Saving protects money. Investing grows it. Time matters more than timing. Behavior matters more than intelligence. Simplicity beats complexity. Patience beats excitement. If you remember these principles, you are already ahead of most people. Final message to beginners. You do not need to rush. You do not need to impress anyone. You do not need to chase trends. You need to understand. Start small. Stay consistent. Think long-term. Wealth is built quietly, over time, by people who remain disciplined when others react emotionally. So tell me, how did you find today's topic? Share your thoughts in the comments, and if you believe this video can help someone in your colleague or friend circle, make sure you share it with them. Education grows when knowledge is shared. This video is created for educational purposes only. For more clear and practical financial education, subscribe to Money Depth Insights. I'm John Array, and I'll see you in the next video.